What is your investment journey for 2026, or what is your investment plan for the year 2026? Have you had a plan to start investing? You are thinking how you're going to start. This video is very good for you. It's going to be a very good resource for you to use as a guide starting investing in 2026. As a matter of fact, I am making this video in response to the request from one of my fans who wrote me to ask for guidance as a Nigerian who want to start investing in stock market, in bond market, the likes. He also mentioned that it's been long that he saw my videos on Facebook. Very right. I thank you for making that observation, because I've been away from social media for a very long time due to some circumstances beyond my control. If you want to start investing, I want you to pay a very good attention to this video. I want to encourage you to save this video, like it, share it, also subscribe to our channel so that you can continue to benefit from content that we release from time to time. You can help others benefit from it. By the grace of God, as you'll be seeing me often giving out some financial lessons, I wouldn't call it advice. Whatever you hear from me is just for information purposes. You can take whatever information you have here and do your own research. You can seek professional advice. Let's start. Is this going to be a teaching? It's going to be a long teaching. I have prepared some materials so that I can give you a proper perspective to starting investing in 2026 as a new beginner. As a matter of fact, this person thought it wise to consult someone who is knowledgeable. It is good to understand the process of investing before starting to invest in any alt investment. It keeps you ahead of other beginners for you to think of what is the process for you to start investing. And I want you to note that investing, take it as a 5-layer approach to investing. Understand that when you are investing, you want to protect yourself. You want to protect yourself, protect your money, protect your assets. Likewise, you want to ensure that you build cash foundation. That is one of the reasons why you want to invest. Again, you want to start investing small. Don't start big, but start where you are, a small bit. Over time, you can increase your investment and make your investment on autopilot. Lastly, you want to avoid common mistakes. You want to avoid common mistakes in investing. I'm going to take you through some steps in order for you to achieve your investing goals in the year 2026. The first thing that you need to understand, or the first step you need to take in investing is get your financial foundation right. You need to get your financial foundation right before investing. What are the financial foundations that you need to get right? Number one, you need to be able to keep emergency fund. Ensure that you have emergency fund that can take care of your expense for about 3 to 6 months. If what you can take is between 1 to 2, 3 months, is still okay. Ensure that you have emergency fund. Also, ensure that you don't have any high interest debt that's choking you. No high interest debt that's choking you. Since you don't have much debt liability, they have to repay back. Because if you have a high debt you are servicing, you might not be able to have enough cash flow for investing. Also, ensure that you have stable income. You need stable income flow for you to continue investing. Lastly, in this step is to be able to leave your money in the market in the long time, at least for the minimum of 5 years and above. You need to be able to think of long term when you are investing. Because in other environments, All over the world, there are people who do not have that regular income. Their income is irregular. You want to ensure that you have regular income that you can use for investing. Currencies can swing in some part of the world so violently. Unstable currency in terms of the exchange rates. Also, you have some regions that have a lot of emergency issues like political instability, economic downturn, I know those stuff. These are the things you have to consider when investing. Also, consider your medical costs. You have to ensure that you take care of your health. This is very, very important. You have to ensure that you have enough money out of pocket, money to take care of your medical needs. Where can you keep your emergency fund? You can keep your emergency fund anywhere. It doesn't matter whether you're in America, you're in Asia, you're in Europe, you're in Africa. You have to know where you can keep your emergency fund, where you can quickly access those funds for immediate needs. The first place you can keep your emergency fund is in the money market. If in Nigeria, you look for Nigerian money market funds that you can quickly invest your money, or you can keep your money in high yield savings accounts, or you buy what we call treasury bills. Those short-term bonds, maybe 3 months, 6 months treasury bills, you can quickly turn to cash when the need arises. Don't forget that you have to protect yourself. The goal here is to maintain what we call safety first, not return. When you have some funds that can meet your immediate needs, it keeps you in a proper shape mentally. Number 2, the step 2 you need to take when you want to start investing is that you learn the right mindset. Everything is about mindset. You need to understand what mindset do you need to start investing. Now, because successful investors, there are things that they do, there are things they don't do. You understanding these things keeps you ahead of others who do not learn them. Learn the right mindset. Successful investors will not chase quick profits. If you want to be successful in the market, you are not looking for quick profits. Don't forget, to be successful as an investor, you are looking at long term. Also, they don't buy tips from Telegram groups. They don't stay on Telegram groups, invest in this, invest in that. They do their due diligence. Like I'm talking to you right now, based on the tips that I'm providing, you have to do your further research. Successful investors don't trade daily. They don't trade frequently. They look for target investments. They keep that investment for the long term. They don't panic when price fall. They don't panic when price fall because market fluctuates. It might favor you today and might not favor you tomorrow. You have to have the right mindset that this your investment can fluctuate in the short term. Now, what do successful investors, what do? First, they make their investments automatic. They invest automatically. They ensure that their investment is diversified. They don't just invest in one single stock or have one single investment. Their investment is well diversified across different industries and different markets. Also, they don't invest for the short term. They invest looking at the decades, tens of years, because you actually profit from the capital market when you invest in the long term. They don't look at the noise in the media, the noise. Their focus is on their goal, what they want to achieve. Because the most important idea here, learning the right mindset, is to be able to do what? To be able to get into the market in time. You cannot time the market. The earlier you get into the market investing, the better for you. It is not too late, no matter where you are in your investment journey. Step number 3 to start your investment journey this year is to understand what you are investing in. You need to understand what you are investing in. Proper understanding of the type of market you are investing in, the type of investment you are investing in is very, very important. Let's talk about some of those things you can be investing in. Number one is the stocks. What are the characteristics of stocks? Stocks give you ownership in a company. You become a part owner of that company. Two, in the short term, as I mentioned it earlier, stocks fluctuate in the short term. So it can fluctuate, it can come down a bit during your period of investment. Understand that. Also, stock is best long-term inflation protection. Stock is what? Best long-term inflation protection. If you want to benefit more, for you to be able to recover from inflation or protect your investments against inflation, stock is good as an investment vehicle. There are some stocks that are recommended, like we can recommend your index exchange traded funds. Index exchange traded fund, that is index ETFs. Like you have, when you are investing, you are not just investing in one stock, you are investing in portfolio of stocks. Another thing you can invest in is bonds. Let's look at some characteristics of bonds. Bond is like a loan that you give to a government or a company. In return, they give you some fixed return interest. They give you a kind of steadier income. They do not actually fluctuate like the stocks. Their return can be a bit lower than the return from the stocks. Don't forget, all of you, that if you remember your economic studies, the higher the risk, the higher the return. The lower the risk you're taking, the lower the return. So bond is a lower risk investment. So it gives you a steadier income. Also, it can be a cushion when stocks fall. Bonds serve as a cushion when the stock market falls. Then another thing you can invest in is you invest in just cash or money market. So investing in keeping your money somewhere or in the money market just to preserve a bit your fund. Serve as a safety net. It has lower risk. Also, is for short-term needs, just like keeping your emergency funds is for short-term needs. Those are some of investment vehicles you can have in 2026. You could also have your investment in real assets or talk about alternative markets, like investing in real estate investment trust, real estate REITs, real estate investment trust, or investing in commodities like gold, silver, precious stones, or precious metals. This might not necessarily be for beginners. It's for those who really understand who understand this type of investment. The fourth step here, as a new beginner to start investing in the market, is what is first step you need to do is to choose your investment platform. Whether you are in Nigeria or you are in the US, you are anywhere in the world, you need to choose your investment platform. How do you get your money invested? What is the channel? That's the investment platform, the channel through which you can invest your money. The step 4 is choose your investment platform, which is very, very important. In anywhere you are in the world, you look at your local environment and see what are the investment platform, that is channel through which you can start investing. As you choose the platform, you have to decide what type of local investments that you can start investing in. For example, in the context of a Nigerian, you can have what we call Nigerian stock market. You could have Nigerian mutual funds. There are treasury bills, as we mentioned earlier. There are Nigerian bond funds. Nigerian bond funds. What are the advantages, the pros of this type of investment is that they are simple. They don't have any foreign exchange restriction. Because your investment is local, it's very simple process for you to start investing. There is no forex issue around it. The disadvantage is that it is prone to inflation risk because it's localized. So whatever inflation in that market, your investment will be affected. Also, it can is also prone to what we call currency devaluation risk. Currency devaluation risk. Now, your investment channel, you can also use it to invest in foreign markets. Like example of dollar-based investments. You can have dollar-based investments. It can be dollar, it can be any currency-based investment of any international markets that you can invest in. For example, if you want to invest in the US, you have what we call the US listed exchange traded funds. For example, you have the Vanguard Total World ETF, that is the VT. There are other investment portfolios like that, like Fidelity have a lot. There are a lot of them. You can do your research. These are just some of the examples that I can have at hand at the moment. You could also invest in what we call Vanguard Total Stock Market, the VTI. These are very good investments. VXUS, which is the Vanguard Total International Stock ETF. You could also have what we call the BND, Vanguard Total Bond Market. You could also have the Euro bonds and dollar mutual funds. These are international US-based investment funds that you can invest in. If your platform, the channel through you are investing, accommodates all of this, you can do your research and see which, apart from my local investment opportunities, which platforms can I invest in that can give me opportunity to invest in other international markets. What are the pros of investing in international markets? It gives you what we call currency protection. It protects your currency because of exchange rate difference. When the exchange rate of one becomes stronger than your local currency, that can protect your currency. Also, it gives you global diversification. Your investment is beyond your local border. You can invest in other international markets. The disadvantage of investing in international markets is that it is prone to forex exchange. You need foreign exchange to be able to invest in international market like the US. You need to convert your local currency to a US dollar or Canadian dollar, whichever way you want to invest your money. Some of these can require some minimal investment amounts that you may need to start investing with. Now, you can do a balance of investing your local market and international market. By that, you have the benefit of investing locally and also investing internationally. That's very good. Look for platforms that can give you opportunity to invest locally and also internationally. Meaning that you are not just investing in just a stock of a company, you are diversifying your investment portfolio. Step 5, to ensure a successful investment journey in this year or any time that you want to start investing, is that you decide what is your risk level. You have to understand your risk tolerance, that is your risk appetite. What level of risk can you accept as you start investing? What level of risk can you accept? You need to ask yourself whether you are investing for retirement. Are you investing for retirement? You need to ask yourself that. If you are investing for retirement, there are some investment risks that you can still accommodate now so that you can be able to meet your retirement goal. Depending on your age, how close you are to your retirement, there are some investments that you cannot go into, or it gives you an idea of how you're going to have your investment portfolio mix. Whether you're going to, what percentage of fund go to stock, what percentage of fund go to bonds. Also, you need to ask yourself, are you investing for your children's education? Are you investing for wealth building? Are you investing for a particular future project? Maybe you want to buy a house in the next how many years? Is that the purpose of your investment? It gives you an idea what type of investment risk that you can take. How long are you investing? If you are investing in less than 3 years, less than 5 years, or over 5 years. Now, because there are some time horizon that are being provided by investing professionals. For example, if your investment is less than 3 years, it's not advisable for you to invest in the stock market less than 3 years, because you gain more when you invest in long term in the stock market. So your investment in stock market will be zero if you target less than 3 years. If your investment time horizon is from 3 years and above, you can invest 40 to 60% of your money in the stock market. And if you are projecting to invest in the market for over 10 years, of course, up to 80% or 100% of your investment can be in the stock market. Because even if there is some volatility, some swing here and there, the market can recover itself within that period. These are some rule of thumb that you can follow to start investing, or also to cushion your investment risk. Number 6, step 6 of starting investment is that you start with simple, diversified, low-cost fund. You start with simple, diversified, low-cost funds. There are some funds that require some administrative costs that are high. They take some investment vehicles are not that cheap. You have to look for those that match your own investment profile. For beginners, we've identified some options that you can take to start investing. The options I'm listing here, you can take one of them, not necessarily that you have to take all of the options. You can start with any of these options that I'm going to mention. Number 1 is that you can invest in one fund global portfolio. One fund global portfolio, like the Vanguard Total World ETF. Vanguard Total World ETF. What does this provide you? This is a US stock. This contains US stocks. It's an international stocks also, beyond your local border. It also incorporates into its portfolio some developed and emerging markets investment in it. Also, in this portfolio, it has thousands of companies at once. So you are investing in thousands of companies at a go. By the time you invest in this type of market, that is in this type of fund, which is Vanguard Total World ETF, VT for short. In this kind of fund, when you invest in it, just invest and set it and let it roll on its own. You just set it and automatically you continue to invest in on a monthly basis or as convenient for you. Number 2 option is to invest in what we call 2-fund classic portfolio. 2-fund classic portfolio. 2-fund classic portfolio is some of them are one, VTI, that is US total market. US total market, you can research more on all of these features, the advantage, and I won't be talking about most of their features right now, just to give you an idea of the type of funds you can invest in. You can also invest in what we call VXUS, that is an international stock market. It's a total stock of well-diversified US-based and international-based investment. Option 3 is to invest in what we call stocks plus bonds balance portfolio. So you are combining stocks and bonds together at the same time. What are the type of funds that hold this type of investment in them? You have the Vanguard Total Fund, the VT or the VTI or the VXUS combined. You also have the BND, that is US Total Bond Market ETF. US Total Bond Market ETF. These are good investments for a start for new beginners, and even for some advanced investors who want to preserve their money. They just want to leave it and let it roll without doing much of any work, trying to research into any particular company, getting information, because you are investing in so many companies at the same time. You can invest in any of these three options. Now, your allocation strategy, it depends on your risk level, whether you are conservative or you are aggressive. Conservative means that you are risk averse. You don't like much risk. If you are aggressive, you like more risk, going to take more risk. It tells you how you can invest. So I can just give you a little scenario how you can invest your money, your money based on your risk tolerance. I mentioned earlier, I can still repeat here. If you are conservative, you are moderate or aggressive. If you are conservative, you don't want to invest much of the money in the market. You are afraid of the stock market fluctuating and going against you. You want to invest in the long term. You can invest like 40% if conservatively, 60% moderately, up to 80 to 100% if you are an aggressive investor. That means that you can share that between stocks and bonds. So if conservatively 40 stock, 60 bond. Moderately, 60 stock, 40 bond. Aggressively, 80 to 100% stocks, while you have between 20% to 0% in bonds. Now, you could also look around you and say, what options do I have? Do I have the options to invest locally, or I have the options of investing internationally? So if your option is locally, you look for what we call low fee index mutual funds. Low fee index mutual funds. Like I said, this is a long teaching. You can just follow me as I go in this. If your option is limited to your local market or local country, invest in money market funds, bond funds, invest in your local country equity index funds. For example, as a Nigerian, you can invest in Nigerian NGX 30 or NGX 50 type of fund, like that. Now, what are the things you need to avoid as you are starting out to invest? Number one, you need to avoid unregulated investment schemes. Any investment that is not regulated by the government or by any government agency, you need to avoid that. Avoid any investment that promises guaranteed return. Any investment that promises guaranteed return, you need to be scared of that. Also, forex trading is okay. You have to be very knowledgeable and understand how you can do the trading very well. If you have that knowledge, there are some forex trading mentorship out there that they say they know all of this. You have to just be careful so that you don't lose your money. As a starter, I wouldn't advise you to start out going for forex trading on your own. Also, be aware of crypto hype. You know, the cryptocurrency is there. If you understand the fundamental, good. If you are not so sure of what cryptocurrency is all about, I will ask you to avoid that as a beginner investor. Step 7, what you need to do, you start small. Start anyway. You start small. Don't say until I have a lot of money. So just start small the way you are. Even with your $10 per week is something. Or you can start with, as a Nigerian, or look at yourself anywhere. You can start maybe 10,000 naira per month or $100 per month. Is a lot. It's a good start. Because when you continue to invest, before you know it, the compounding effect takes place. Don't forget, over time, you reap the return of investing in the market. One of the things that you need to do to be able to succeed as a small investor is that you automate your investments. You give like a standing order every month, every week. This amount of money should be sent into your investment channel. You can get some app that can do auto payments into your investment channel. Step 8, for you to be successful as a small investor is that you reinvest dividends. There are some stocks that pay dividend. Don't take those dividend out. you plow them back. You reinvest those dividends. You turn on your what? Your dividend reinvestment button on your investment app. It's a great way of an income, earning more income for you. Number 9, you have to do what we call periodical rebalance. That is, you assess your portfolio maybe every year, every 2 years. You look at your portfolio, how is it doing, and you rebalance. For example, you want to ensure that your investment portfolio is that 60% stock, 40% bond. By the time you look at the balance of your investment, if your stock is more than your threshold in value compared to the percentage your bond is, you can sell some or buy more of that type of portfolio to keep it balanced. That's what we call rebalancing. It's a good way to make sure that you maintain the discipline of your investment portfolio. And number 10, avoid common beginner mistakes. What are the common beginner mistakes that you need to avoid? Number 1, do not panic sell in times of crashes. Don't forget, it's long-term investment. You want to invest in long term. You don't sell in crashes. When the market fall and you rush out, the market is falling, I'm going to lose money. Don't forget that the stock market fluctuates. You want to stay there and be consistent, continue investing. The market will always balance itself, recover. Also, you do not trade frequently. I mentioned that earlier. You don't trade every time. And don't only buy your local bank stocks or local company stocks. Don't only buy that. Ensure that you have well-diversified portfolio. Don't only chase high dividend stocks. There are some traps. It can be a set of traps. Do not chase high dividend yield traps. This will give you high dividend payout. Just be careful of that. Make sure you do your research and you understand what that investment is all about. Do not borrow to invest. Do not borrow to invest. There is a term for that. I forgot the term now. Put emergency money in stocks. Do not do it. Your emergency fund is your emergency fund. Do not invest that in stocks. Do not invest because your friend told you that investment will give you sure profit. Do not do that. Ensure that you understand that investment before you invest. Dear friends, these are the few information I have for you as a beginner if you want to start investing. You can take this information, do more of your research so that you understand where to start. Don't forget to like our page, to share this video, to subscribe to our channel so that we can continue to give you more wonderful and content-rich information. What we need in our investment journey is to ensure that we balance up everything. Don't forget what we have mentioned. You need to understand, that you need to protect your assets. You start small. You understand that your investment is long term. You ensure that you understand what you are investing in. As a follow-up to this video, I'm going to be sharing some apps or investment platforms that you can use, most especially as Nigerians, to start investing in your local environment. Thank you for staying tuned and watching this video. I know you have learned 1 or 2 things. Don't forget, seek professional advice. See you next time. Thank you.